A warm welcome to everyone who's joined us for the very first episode of Let's Talk Energy, a new weekly podcast from Rystad Energy. I'm your host, Noah Brenner. I've been covering the evolution of energy for the past 20 years. Each episode, I'll sit down with Rystad Energy experts or a special guest to unpack the most exciting developments in the energy world. Expect a conversation that you can understand, even if you're not an expert, but we're also not going to shy away from getting into those all-important details. Like Rystad Energy, we're going to cover a wide range of energy issues. So anything from oil production, which we'll be talking about in today's episode, to power demand, to market-moving geopolitics. I'm excited to have you all with us, so let's go ahead and get started. Now, we've seen a tangible shift by companies and governments over the last few years from leaning into the energy transition to really re-emphasizing oil and gas production, whether that's for energy security or energy affordability, or simply that's where they see their own competitive advantage. That's put the spotlight once again on the oil industry's ability to replace the reserves that we use each year. But it's one thing to say that you want to boost reserves and eventually production, but it's another thing to actually do it. So are all the catchphrases, drill baby drill, and the cash actually putting more barrels in the bank of global oil reserves and eventually gas in our tank? I've got Artem Abramov, our deputy head of analysis, joining me today from Oslo, who is perfectly placed to tell us just that. Artem, welcome.
Yes, hi Noah, and thank you for having me here today.
Well, let's talk energy. Now, Artem, I couldn't help but notice that path that I've described the world being on actually reflects your career here at Rystad Energy quite a bit.
Yeah, it's a fair statement. I think I started at Rystad Energy as a shale analyst. Actually, I was looking for many years at the North American oil and gas, and that's really my key area of expertise. And then around the COVID period, I got really interested in energy transition, all the clean technologies, things like hydrogen, carbon capture, biofuels. And I was overseeing our new energies research in the last few years. And now things are changing again. I'm actually moving back to oil and gas. So I will be leading our global oil and gas research from this fall. So effectively, it is a little bit of my personal energy transition, which is to some extent representative of some of the changes we are seeing in the industry as well.
Like I said, you're the perfect person to explain all this to us. So I want to mention that we've got our annual Global Oil Reserves white paper is out for our clients. We're not going to spend too much time on that. There's a link in the show notes where everyone can read it. But briefly, let's touch on our headline figure that the world has about 1.5 trillion barrels of recoverable oil reserves. And so, Artem, how does that compare to last year, and what's changed and why?
Yeah, so we publish our annual reserve report every year. And we monitor the changes, trying to understand where the world is heading to. And one of the main questions basically we're trying to answer is, do we have enough oil in the ground? Or maybe to put it kind of more accurately, do we have enough oil that can be recovered economically to support most realistic demand projections going forward? And this year, I think we saw some positive developments. In the last 12 months, I think there were some upward revisions coming from West Texas, also from Argentina, Vaca Muerta shale. So the number went a little bit up. But our main message, I would probably say it is still quite comparable to what we communicated last year, is that at the current levels of exploration activity globally, we might run into very serious challenges 10, 15 years down the road, because we are not finding enough oil to support, let's say, more conservative energy transition scenarios, to support the scenarios with more ambitious oil consumption in long term.
So let's talk more about that. You had a post on LinkedIn. You were pointing out that there are really kind of two schools of thought when it comes to future oil supplies and whether or not we need another oil and gas development super cycle. Now, one school of thought basically suggests that reserve replacement is a serious challenge for the industry. We'll face the consequences in the 2030s, especially if, as you said, oil demand remains resilient and the transition progresses at a pace that's maybe slower than we anticipated just a few years ago. The opposite view, which maybe we've seen reflected in the commodity price performance over the past few years, is essentially we've got US shale inventory, we've got OPEC spare capacity, we've got improving recovery factors out of various fields, and demand has also proven to be more malleable, more responsive to higher prices. And so we're just fine. And there's no need for this kind of conventional upcycle or super cycle that you've talked about. Now, I think I may know the answer to this, but I mean, which school do you subscribe to if you need to pick one or the other?
Honestly, I'm quite convinced that we will see another super cycle in this industry, and maybe not a single one, because yes, 5-6 years ago, at the onset of COVID-19 pandemic, the views of accelerated energy transition, they really became very popular. Like, we thought that we could electrify everything out there really fast. We thought that electric vehicles would penetrate global fleet extremely quickly. But today, we still have maybe only a couple of examples globally, like Norway, where this rapid transition actually happened. On the other side, we have a lot of large European car markets. We have the US, where electric vehicle penetration faced certain obstacles, and we could discuss for a very long time what really caused this slowdown in the adoption. There were some infrastructure bottlenecks, supply chain bottlenecks, costs of EVs are not falling as quickly as we hoped, but we just have to acknowledge that it takes a longer time to actually adopt some of these technologies and see the full impact of energy transition. So today, quite many people, including ourselves, I think we have more maybe constructive and more conservative views on how quickly oil demand would slow down in the next 20-30 years. And if you take if you take this observation as an assumption into your future modeling, you would quickly end up with the conclusion that we are not discovering enough oil. Exploration activity has been very, very low since 2015, 2016. Reserve replacement ratios, they are at a very low level, but definitely less than 100%. Doesn't matter how you look at it. And yes, the US shale industry drove a lot of optimism. A lot of people felt that US shale became a new, pretty much unlimited source of oil going forward. But even shale companies, they are now hitting some limits on how much oil, how many basically new wells they can drill at relatively low oil prices. If you go back to the environment where we were in 2014, when oil prices were above $100 per barrel, yes, we have just such unprecedented potential in many parts of the world, but this potential has to be proven. It has to be discovered, and it will take time to, prove all these tier 3, tier 4 locations. And we're not there yet, and that's why I believe that we will need another upcycle, very high oil prices, in order to trigger additional activity and deliver on the demand projections.
Well, so I definitely wanted to talk more about some of these thoughts on U.S. shale in just a second, but I do want to make sure that we touch on something that you just hit on here, which is price. I mean, that's probably the thing that most people, both inside the industry and outside the industry, really care about. And so, if all these reserves aren't necessarily available to us at today's prices, what price might we need to see in the future to secure additional supply, to secure the necessary supply?
Yeah, well, first of all, I think it's quite important also to differentiate between short-term requirements from prices and things which we really need in 2030s, 2040s on a much longer term perspective. And
so let's talk short term and then let's talk long term.
In short term, of course, there are reasons why oil prices where they are. The market is pretty well supplied, and we have so many new oil which is coming to the market now in 2025, and there is a pipeline of additional projects which will become operational in 2026. Whereas demand growth globally has been quite disappointing. On top of that, we have OPEC Plus with very significant spare capacity. They've been regulating the market artificially to some extent since 2015, and there are different estimates, but I think everyone would agree that the volumes which they can bring to the markets within a fairly short time frame, if they want, are quite significant. So short-term story remains, I think, quite consistent, is that there is a reason why we have seen this downward pressure on oil prices, and we don't need oil prices to go much above, let's say, $70 per barrel to see balanced oil markets in the next 3, 4, maybe 5 years. But as you move to the next decade, then you are really running. OPEC Plus is kind of running out of fuel. They even in countries like Saudi Arabia, UAE, they will need to increase the spending. They will need to increase oil field activity in order to achieve additional production growth, in order to boost their production capacity. And in the regions like the US, like North American shale, I would probably say we'll need to have sustainable oil prices above $80 per barrel in order to see US oil production growing for many, many years gradually. Once you get to this 80, 90, $100 per barrel range, theoretical potential of the US shale becomes truly unlimited. Or to put it differently, we don't know for sure, like no one knows for sure how many locations in tier 3, tier 4 shale plays are commercial if you really get to sustainable $100 per barrel price environment. There are just so many basins where we haven't seen any meaningful activity since 2014. No one was interested in these basins, and now we just have access to much better technology to actually try these areas.
So, if I'm understanding you correctly, we might need an oil price that's certainly higher than it is today to incentivize additional production, say 5 years down the road. But it might not be the $150 or $200 per barrel that we've seen predicted in investment bank supercycle notes of years past.
Yeah, I think it's always there is always a risk of making such projections in public domain because people would remember it. Like I would never say that I expect oil prices to get to $150 per barrel, even 5-10 years down the road, and stay there. But I don't exclude the possibility that we will see market shocks of such magnitude as a result, of the decisions which we didn't make in the last 4 or 5 years, because a lot of companies, they were really, reducing exploration activity, reducing their focus on exploration, buying into the story that energy transition would accelerate. And now we're seeing this shift. We're going back to the views that it would actually take longer to see the full impact of the transition.
So let's dive in on US shale because, as you said, there are probably more wildcards, more unknowns with shale, and it's certainly been the portion of the industry that has most surprised us probably over the past decade and changed the overall market dynamics. And so you're talking about, say, those tier 2, 3, 4 potential locations, the potential for shale to grow, but will we see the same? Could we see? Does it have the capacity for the same rapid growth that we saw kind of in the early shale days when it was adding, potentially 1 million barrels a day per year or more?
I think it has capacity to get to the same growth rate, but it requires a combination of factors. It requires both very stable and high commodity price environment. So we need to get to, I would say, maybe $100 per barrel plus if we want to see shale growth of 1 million barrels a day magnitude per year. And even if we get there, let's say we get there tomorrow, I don't think the companies will rush, changing their capital programs immediately. Simply because the business model in this sector has actually changed quite dramatically. The production in the US is really controlled by publicly listed companies, and the investor community remains conservative to some extent, and they would like these companies to prioritize capital discipline, and they want to see fairly, competitive cash returns. This has been really the main focus in this industry, the main focus of the investor community since 2020, and it will take some time to see significant changes in this attitude. But commodity price cycle in itself will be needed as a signal for the investor community. Like if we get to $100 per barrel, and if we stay there, the investors around the world, they will start realizing that something has changed fundamentally, that we are not producing enough oil. So that will be a very important market signal. And 12, maybe 24 months down the road, you will start seeing some shifts. You will start seeing, companies kind of opening up a little bit in terms of their capital budgets, and they will start increasing activity, and increased production will be an implication of that.
And I wanted to stick with that corporate strategy theme here for just a second in terms of, many, not just Western firms that are listed on stock exchanges and have, an investor base that's looking for returns as well. Many national oil companies now are publicly listed. And so how do you see national oil company strategy playing into some of these trends around reserve replacement as well? Would you expect kind of the same, perhaps, conservatism around spending that we've seen from some of the public players, from some of these national companies?
Yeah, I think it varies. Like the business model among national oil companies varies quite a lot, from country to country. Of course, we have examples of Equinor, which is a very special case, and Equinor, in terms of the business model, is much closer maybe to majors like ExxonMobil, Chevron, or Shell or BP. And then you have national oil companies in the Middle East, also Southeast Asia, which tend to have very different business model. Like their main objective for these companies is not necessarily to maximize value creation for the investors. It could be something different. It could be something in the area of energy security. It could be something in the area of fiscal revenue, which is of course very important driver. But they're not always obliged to make project decisions on the basis of traditional kind of market philosophy. So that's where you have the big difference. But in general, I would definitely say that national oil companies, they managed to kind of navigate through the last cycle very successfully, because they were not they did not experience that much pressure from the investor community on the energy transition side, and they maintained a little bit more, traditional philosophy. So their strategy was a little bit more resilient, and that helped them to avoid, rapid changes in their strategy, which was not always appreciated by the investor community. Or if you look again at European and American majors.
Now, I want to pop back into shale because I feel like there's a few more questions there we need to explore, and particularly around, wild cards. What is it that could potentially surprise us to the upside or the downside? Is there, potentially technology? Are there things that could make shale even more of a wild card, perhaps, than it already is?
Yeah, so let's maybe talk about the technology first, because it's really I'm fascinated by the progress this industry is making every year. It's not a new sector. It's already been more than 25 years since George Mitchell has proven that shale gas can be extracted in economic manner in a Barnett shale, and still every year we are seeing longer and longer wells. We are seeing more and more intensive completions, and we are seeing some major technological breakthroughs which were perceived as a complete science fiction just 5-7 years ago. There is a very long list of what operators are now trying to do and sometimes adopting as a standard completion design. Like I don't know if you heard about this U-turn wells in Texas.
The horseshoe wells. Yeah, incredible.
Wells.
Yep.
So I still remember, I think it was 2018 or 19 when Shell drilled the first such well in Delaware Basin. And it was really all over all scientific publications. It was a pilot project at that stage. And now these wells are actually quite common in both Midland Basin and also in Delaware Basin. Several operators there are actively completing them. And the entire goal, it's a complex design. Like it's difficult to drill it a U-shaped well horizontally. But ultimately, it is all about costs. This design allows you to reduce your drilling and completion costs compared to the situation where you need to drill two adjacent wells, just because you need only one vertical section. That's pretty much the only advantage. And whatever helps you to reduce the costs, well, is extremely popular among your investors these days, as we already discussed. So all these small technological advancements, they're still happening, and industry is becoming more and more efficient every year. And I think we'll all still be surprised by what kind of efficiency gains we're yet to see from North American land sector.
Mm-hmm. So I've got just one more question around shale, and that is, to this point, it's been a U.S. story, but will that continue into the future? You mentioned the Vaca Muerta shale play in Argentina at the top of the episode. We've also seen renewed shale exploration and development in the Middle East and beginning in North Africa as well. And so are these plays outside of North America becoming material to our projections for future oil supply?
Yeah, I guess you said it's the U.S. It has been largely the U.S. story, but I feel obliged to correct you a little bit because our Canadian viewers might be a little bit offended.
A North American story. A North American
yes,
story.
Because we shouldn't forget that in Canada, in the Deep Basin, this is the area where we have seen some of the most impressive shale gas results historically. So yes, it has been North American story. Vaca Muerta in Argentina is definitely another hot spot for shale activity. And, it is still, from a certain point of view, it is early days. The activity in Vaca Muerta, there was some activity already for like 10, 12 years, but every year the wells are getting more and more productive, more and more economic, and they're like maybe 3 to 4, 5 years behind typical best practices which we see in the US. So there is still a lot of upside in terms of what we can see. Okay. And commercial potential there is proven. Vaca Muerta is already the most significant driver of oil and gas production in Argentina. And then you have many other places where, in theory, you have significant shale potential. You have Australia, you have Middle East, you have some pretty interesting shale resources in Eastern Europe. There are some parts of Latin America, in addition to Argentina, where shale potential is significant. Eagle Ford shale doesn't stop at the Mexican border. It actually extends into Mexico. So you have some opportunities there. In all these areas, sometimes geology, just from a pure geological point of view, things don't look as impressive as in the best place in the US. So to some extent, in North America, the industry was lucky to get access to all sweet spots. But still, it is not that bad. Like, it can be, as technologies kind of get better and better, shale can become economic in all these regions which I just mentioned. And we are seeing a lot of attempts, a lot of exploration, especially in the Middle East and also in Australia. And in some countries, shale activity faces certain regulatory obstacles. But in the areas where you don't have these obstacles, I'm actually quite optimistic about how significant unconventionals can become 10, 15 years down the road.
And so I want to make sure that we've got time here to talk about a whole nother part of the industry that's huge is the conventional side of things. And certainly, shale's not the only supply factor. How does conventional supply, particularly that of OPEC members, major non-OPEC producers like Brazil, where does that play into this?
I think we are now in a very, again, it brings us back a little bit to short-term market dynamics. But right now, we are in the situation where you are getting some growth of oil production from everywhere in the world. So, and either these countries are increasing production, like Brazil, for example. There are some new projects which are coming online. We have Guyana as well. Or you have several members of OPEC Plus coalition, which have a potential to increase production significantly. So we are in this oversupplied market situation. And getting back basically to your question, there is a lot of potential to see accelerated conventional supply. And, we're talking both about onshore operations and also offshore, deep water shelf activities. We just got the new generation of large projects coming in Gulf of Mexico. There was this discovery actually just a few weeks ago in Poland, which is apparently the largest oil field discovered in Europe since 2011-2013 period, which is quite impressive in the Baltic Sea. But of course, it's still a little bit speculative in terms of how quickly it will be developed. But there are the news flow has been very, very significant. We're seeing a lot of discoveries, a lot of exceptional execution, like the projects are being brought online, fully in line with operator communication without any delays. This is like becoming a common trend everywhere in the world. And that is one of the reasons why I'm personally talking more and more about the new super cycle in the industry these days.
And so, but I want to ask, you highlighted that we've had poor exploration success over that. The trend has been for poor exploration success. And honestly, the trend in development, say until the past 12 to 18 months, as you highlighted, has actually been of lower reserves being brought into production. But over the past roughly 12 months, we have seen this, about 50% more oil reserves brought into production, I think you highlighted. And so, are we seeing the fruits of AI and digitalization and some of the technology advancements to think that this could be the new normal, that higher exploration success, that better project execution is actually going to be kind of the new baseline moving forward?
I definitely think that we already seen clear evidence that the amount of resources we're putting in production every year, which we saw in the last 12 months, could become a new normal. So as you said, it increased by around 50%. We are still largely leveraging on a very large backlog of resources which we discovered in the last 15, 20 years. Exploration activity itself, apart from selected examples, which I mentioned, is still relatively limited. So we will need to increase it significantly if we want to avoid, supply deficit in 2030s. But this hasn't happened yet. And then, in terms of the impact which AI and technology advancement can make, I really think about AI as just a boost to natural technological learning curve in this industry, because something new, the industry kind of keeps innovating. And even before we saw, the emergence of AI, every year we're seeing some efficiency gains, there were some new tools available to the industry to boost exploration success. Now AI will accelerate the learning curve, and we already seen it in some aspects of the industry. The research operations are becoming more efficient, modeling tools are becoming more efficient, and naturally all these will result in efficiency gains also further downstream within the value chain.
Mm-hmm. So if I'm understanding you right, Artem, perhaps we've taken a step up when it comes to project execution, but we've still got some steps up to take when it comes to exploration if we're going to be discovering those reserves that we need to bring forward finally into production.
Absolutely, yeah.
Now, I would love to speak with you. I could talk for hours on this subject, obviously, but I do want to be mindful of time here. Is there anything that we've missed? What haven't we talked about that's keeping you up at night?
Well, we didn't touch on one very important topic, is a geopolitical environment. Because, of course, in the oil industry, everything you could say about future demand and supply outlooks is very sensitive to your assumption on the world we'll be living in going forward. And this industry has a tendency to, experience significant shocks as a result of various sanctions, trade restrictions, and policy shifts. And of course, this is another big area which might impact all the projections which I mentioned today.
Well, that sounds like an excellent topic for a future Let's Talk Energy episode. Artem, thank you so much for joining us.
Thank you, Noah.
So just to recap what we've heard today, the world has plenty of oil, but not necessarily as much oil as we need at today's prices. And so prices may need to rise to incentivize the supply that we need into the mid-2030s and beyond. The industry has made good advances when it comes to bringing projects through execution and into production, but there's still more work to be done in exploration to make sure that we're finding those new reservoirs that we'll need. And, as always, shale could be the wild card here that could surprise, perhaps to the upside, perhaps to the downside, but it also could move from North America through to other parts of the world. Thanks for listening to Let's Talk Energy. This podcast is a Rystad Energy production, produced by Laura Rodriguez Skaug and Både. Check out the show notes for further analysis on the topics we've discussed in this episode, and connect with us on social media at Rystad Energy on all your major platforms. Or you can check us out on the website. If you'd like to send us a question or reflect on today's show, email us directly. It's podcast@rystadenergy.com. Please leave us a review and hit that subscribe button while you're there. And most importantly, don't forget to join us next week.